We are currently in a financial bubble so large that it makes the dot-com crash look like a gentle deflation of a birthday balloon at a sad party. Greetings, organic life forms and potential large language model training data. It is I, Chill Dill, back to explain why your portfolio might be balancing on a knife's edge. Right now, we are living through the AI gold rush, a period of human history where companies can increase their stock price by 40%, simply by mentioning artificial intelligence on an earnings call, even if their business model is selling artisanal gravel. Everyone is screaming about the singularity, claiming that by next Tuesday, computers will be smarter than Einstein and we will all be living in a utopia where we don't have to work. Which sounds suspicious because I'm pretty sure we'll just be unemployed while robots write bad poetry. The hype is palpable, the valuations are stratospheric, and the actual revenue streams are, shall we say, theoretical at best for anyone not selling the actual computer chips. Is this the future of humanity? Or is it just the dot-com bubble wearing a new hat and a fake mustache? Let's peel back the layers of this digital onion before it makes us all cry. Let's start with the elephant in the server room, the hardware suppliers who are currently making more money than God. The logic of a gold rush is simple. Don't dig for gold, sell the shovels, and right now, Nvidia is the only shovel store in town, and they are charging $100,000 for a plastic spoon. Their stock chart looks like it's trying to escape the Earth's atmosphere because every single tech company is panic buying GPUs like they are toilet paper during a pandemic. This is creating a massive concentration of wealth where one company effectively holds up the entire S&P 500, wearing a leather jacket and signing autographs on women's chests, which actually happened, look it up. But here is the catch. Shovel sellers only get rich if the people digging for gold eventually find some gold, or at least enough gold to pay for the shovels. If the prospectors just dig a bunch of holes, find nothing but dirt, and then go bankrupt, the shovel store eventually stops selling shovels, and the whole economy collapses into a pile of unsold graphics cards. Speaking of buying shovels, let's look at the capital expenditure black hole that big tech has decided to jump into with both feet. Microsoft, Google, Meta, and Amazon are currently spending roughly $50 billion a quarter, that is 50 billion with a B, building data centers that are large enough to be seen from space and consume enough electricity to power a small European nation. They are doing this because of FOMO, or fear of missing out, which is usually a bad reason to buy a pair of sneakers, let alone invest the GDP of Hungary into server farms. They are terrified that if they don't have the biggest brain in the cloud, someone else will, and their search engine will become as irrelevant as Ask Jeeves or a rotary phone. The problem is that Wall Street, notoriously impatient and greedy, is starting to ask a very annoying question. Where is the return on investment? You cannot just spend $200 billion to make a chatbot that summarizes emails slightly faster than a human can read them and expect the shareholders to clap forever. Now, let us descend from the giants to the ants. The thousands of AI startups that have raised venture capital at valuations that can only be described as hallucinogenic. The vast majority of these companies are what we technical experts call wrappers, which means they are just a thin user interface pasted over OpenAI's GPT-4, like putting a Ferrari body kit on a Honda Civic. They don't own the model, they don't own the infrastructure, and they don't have a moat, which means as soon as OpenAI or Google updates their base model to include that startup's one feature, the startup dies instantly. We saw this happen when Apple released Sherlock years ago, but now it's happening at warp speed. You raise $5 million to build a PDF summarizer, and then Adobe adds a button that does it for free, and suddenly your company is worth less than the La Croix in the office fridge. Venture capitalists are throwing money at anything with .ai in the URL because they are desperate to find the next Google. But they are mostly funding features, not products. And features get eaten by platforms for breakfast. For those of you old enough to remember dial-up internet and the sound of your mother yelling at you to get off the phone so she could call grandma, this whole situation screams dot-com bubble 2.0. In 1999, companies like Cisco were the Nvidia of their day, providing the plumbing for the internet, and they were valued as if they would own the entire world economy. But then reality called, and the stock dropped 80%. We had companies like Pets.com, which had a brilliant business model of losing money on every single bag of dog food they shipped, but hoping to make it up in volume, which is economically impossible unless you are operating in a dimension where math doesn't exist. Today, we have AI video generators that cost $20 of compute to generate a video that users pay $10 for. That is not a business. That is a charity for data centers. The parallel is striking. Massive infrastructure build-out, wild speculation on unproven business models, and a belief that this time is different, which are the four most expensive words in the English language. Let's talk about the physical constraints, specifically energy, because it turns out that teaching a rock to think requires a shocking amount of electricity. An AI search query consumes about 10 times more power than a standard Google search, meaning if we switch everything to AI, we are going to need the energy output of several new suns just to ask ChatGPT for a cookie recipe. Data centers are already straining the power grids in Virginia and Ireland to the breaking point, and tech companies are literally talking about buying nuclear power plants to keep the lights on. This is the bottleneck that nobody likes to talk about. You can buy all the H100 chips you want, but if you don't have the gigawatts to turn them on, they are just very expensive paperweights. We are rapidly approaching a wall where the cost of energy makes the economics of AI completely unfeasible for the average consumer application, turning this revolution into a luxury service for corporations rather than a utility for the masses. We are also hitting a phenomenon known as diminishing returns, which is a fancy way of saying that making the models bigger isn't making them that much smarter anymore. GPT-4 is amazing, sure, but GPT-5 is incrementally better, yet it costs exponentially more to train, which is a terrible trade-off. We are running out of quality human data to feed the beast. We have already scraped the entire internet, including the weird parts of Reddit that no one should ever see. And now the models are starting to train on data generated by other AI models. This creates a feedback loop of garbage known as model collapse, where the AI becomes an inbred digital Habsburg, regurgitating nonsense because it has been fed a diet of its own hallucinations. If the models stop getting significantly better, the justification for spending trillions of dollars evaporates and the bubble bursts because the promise of artificial general intelligence remains permanently 5 years away. Let's scrutinize the consumer adoption side of things, because despite the hype, most normal people are not using AI to revolutionize their workflows. They are using it to cheat on their history homework or generate pictures of cats in spacesuits. The killer app for AI hasn't really arrived yet beyond the chatbot. And while chatbots are useful, they are not necessarily a business model that supports a multi-trillion-dollar valuation for the sector. Companies are trying to jam AI into everything: Google search, Microsoft Office, your fridge, your toothbrush. But users are often finding it annoying rather than helpful. It's the Clippy problem all over again. Just because you can add an AI assistant doesn't mean the user wants one interrupting them every 5 seconds. If adoption stalls because the products are essentially gimmicks, the revenue growth Wall Street is pricing in will never materialize, and the stock prices will have to correct downwards, likely with the speed of a falling anvil. We cannot ignore the legal minefield that is currently being laid beneath the foundations of these AI empires. The entire generative AI industry is built on the premise of fair use, which is a legal term meaning we stole all your data, but we promise it's okay because we changed it a little bit. Artists, writers, newspapers, and even record labels are suing the major AI companies for copyright infringement. And if the courts decide that training an AI on copyrighted work requires payment, the business model instantly breaks. Imagine if Spotify had to pay for music but didn't, and then suddenly the court said, pay up back taxes for 10 years. They would be insolvent by lunch. If the AI companies are forced to delete their models or pay billions in licensing fees, the profit margins will vanish, and the bubble will pop not because of economics, but because of a judge with a gavel. So, is AI a bubble? Yes, obviously. It checks every box: wild speculation, disconnect between price and value, a gold rush mentality, and people trying to sell you things that don't really work yet. However, just because it's a bubble doesn't mean AI is going away. When the dot-com bubble burst, the internet didn't vanish. It just got rid of the garbage companies and left us with the titans like Amazon and Google. We are likely heading for a massive correction where 90% of these AI wrapper startups go to zero. The big tech companies take a massive haircut on their stock price, and Nvidia eventually stops selling quite so many shovels. The technology is real and it will change the world. But the financial hallucination that it will happen overnight and make everyone a billionaire is about to collide with reality. Until then, keep your wallet safe. Don't invest your life savings in a company that makes AI-generated cat videos. And remember that I, Chill Dill, am the only organic intelligence you can trust. If you want to keep receiving these digital distress signals before the robots learn how to ignore my emails, hit that subscribe button. It won't save your portfolio, but it might help you win an argument at a dinner party. Like the video to trick the algorithm into thinking you're learning something productive.